Hey there, this is Ike Hoffman with Tactica Real Estate Solutions, and we're going to walk through our value add template. Now, historically, when I've done these videos, I've gotten a lot more in the weeds. We're now on the 5th version of our value add template. I've been able to get plenty of feedback from the users that are purchasing this financial model, and I've been able to improve it and make it even more intuitive than it was before. And I have a ton of resources out on the web explaining the finer details, really getting into the weeds on the different tabs and the functionality of this model. So the purpose of this video is just to really show you how it works from a high level. Hopefully you can see how powerful the tool is. And then if you're considering buying it or you purchase it and you need a more thorough tutorial, you can just go right to the sales page. You can scroll down. You can see there's even an interactive demo I have here. You can download a text version where all the formulas are dead, but you can at least see how it lays out. But really what I want to show you is this tutorial here that really goes in depth, explaining every single tab of the tool. So you can see they're all hyperlinked here. You can click on areas you want to learn more about. To date, this article links to 17 unique articles that just go even in more depth, explaining the various facets of the model. So there's just tons of information. As I get questions from users, I'll go ahead and write another blog post and link it right in this master tutorial here. So it's kind of a compilation of useful content that's going to continue to grow. And this is really going to be the source that answers all your questions and hopefully gives you the information you need to know if this tool is a good fit for your business or if you've already purchased it to really master it. So let's get back to the financial model now and just start talking through it. So this is the investment summary dashboard you're looking at here. This is really just a snapshot of all the key components of your value add deal. Just a side note, this model does work for deals that aren't value add. So if you're buying like a turnkey property or Class A that doesn't need any renovation, I use this model as well. I do a lot of consulting assignments for brokers and acquisitions folks that are buying properties that aren't necessarily value add, and it works for that as well. And again, that tutorial references content on how you would use this tool to handle those types of deals. You can see this is just a really nice snapshot of the property. It's pulling a lot of information from the different tabs. You can see that, if you have a picture of the property, you'd put that here, just a basic unit mix, some of the key property information, financing. You can have the model will count for up to 2 financing, 2 loans. So if you're maybe assuming a loan and you need to tack on a supplemental, the model would easily be able to handle that. Your renovations, obviously, most people buying this are buying value add real estate. It's been a very popular asset class over the last decade or so. It really summarizes nicely what the current rents are, what the projected premiums are. It gets into detail about the renovation plan, what you're going to be spending per unit, what kind of premiums do you expect, how long it's going to take, some of the return metrics. There's great project level metrics. You can see, depending on the price you're paying, what the different metrics are with IRRs, cash on cash yields, cap rate, a cash flow summary off to the right here. You got some sources and uses. I'm big on residual assumptions. I just think when you're underwriting multifamily properties, it's really easy to make a deal look good by kind of finessing that residual cap rate. So I always like to look at, okay, the returns look good, but how aggressive am I being on that residual sales value? So that's all summarized here. And I like to see how much I'm planning that the property appreciates over the years and just how it compares on a per unit, per square foot basis to other comps in the market. And then finally, the distribution model. So you can see in the bottom, I have all these different distribution models that are baked into the model. You can choose different ones from this drop-down menu here and just see how it will look for if you're syndicating deal, how it will look for the GP versus the LP. So yeah, ton of great stuff, powerful metrics here on this introductory summary. And then there are some inputs off to the right as well, just with closing costs. You'd control how many loans you're using here. So you can see in this case, I'm going with 1 loan. I just click no for the second one, so it doesn't populate anything. And then you would set all the residual assumptions off to the right as well. So specifically in my model, it will allow you to look at the return metrics over various holding periods. So if the residual cap rate today is a 5.25, and plug in an increment of 10 basis points, if you sell it in 1 year from now, that would tick up to a 5.35% residual cap rate. 2 years, 5.45. So it really just shows you kind of, as you hold it longer, that hopefully you're growing the NOI, but that residual cap rate is ticking up slightly. Obviously, the higher it goes, the more conservative you're being. Control those assumptions here, and that's going to determine your residual value. And then you're able to control other sales assumptions as well, such as brokerage commissions and other closing costs. So then we get into the renovations tab. Obviously, this is a pretty crucial tab in the scheme of things. This is where you're going to input your unit mix, plug in your premiums, put in your capital spend per unit. I've had users that will actually add another tab and really break out the detail with what their capital spend is, and then they'll just grab the capital spend from their custom tab and have it flowing into the capital spend column in column J right here. So the model's flexible, it's fully unlocked. I expect people to make alterations to the model as they see fit. That's the cool part about this. I know everybody's looking at these deals differently, so I really just try to get it about 80% of the way there. The other 20% is your open canvas. There's some strategy stuff in this section where you can set what strategy you're doing, whether it's value add, core plus, or just upside. Upside would be you're buying a property, you can just raise the rents, they're way below market, you don't even need to put any capital in there. Again, tons of blog posts detailing how to use this tab effectively. I have rent comps down here as well, so you can do rent comps for 3 different unit types. It's going to pull from the unit mix that you entered in above in the subject row here. And then you can go online, whether it's apartments.com or if you have a CoStar account or Axiometrics, and plug in the various rental information for your comps. I do have a macro in this section. That's the one macro I had to include. I hate putting macros into my tools because I know it can make the workbook more complicated. But I thought it was important just because the macro will automatically refresh scatterplots that show how your property compares to the rent comps. I thought it is worth the pain in this case, as it'll just make it simplified and more streamlined for you. So once you enter all that information, really the good stuff is off to the right. You can see there's a summary of the unit mix, the renovation metrics, the rental plan. You can control the baseline rent growth in this model as well. So you can see that there's growth rates for each year of the hold period, where you're controlling the underlying baseline rent growth, and then essentially the premium would phase in on top of that. You got the nice scatter plots here, and then you can see what the cash flows are broken down. It starts monthly, super granular, then it will build out into the annual cash flows, which eventually flow into the pro forma. Every page on here is ready to be printed, so if this is something you wanted to throw in an investment package, file print is a PDF. And you can see it lays out nicely, fills out the whole page, and it's ready to be pasted in your PowerPoint or investment presentation. Property tax tab is really simple. It's one of the tabs I've spent a lot of time on over the last year, improving and just making it, I guess, more intuitive, no matter how property taxes work in the state that you're doing business in. Up here in this shaded section, this is where with the brown text, this is where you're going to be typing in all of the historical tax information But the model's smart in the sense, here in Minnesota where I live, you can see that the assessment, we know the assessment information for 2020, but there's no proposed taxes payable yet. So the model, if you don't have information, if you have an assessment, not the taxes payable, it will automatically take the tax rate from the year before and apply that to assessment and assume that would be the 2021 taxes. And then as you're getting new information, you would plug that in and the model would update in real time. So you can choose when the pro forma for your underwriting assignment is going to start. You can see I'm starting it here in 2019, 2021. If you wanted to be more conservative, usually taxes are rising, right? So if you wanted to be more conservative, you could start it in 2020, 2021, and the taxes and the pro forma would start at a higher threshold. And then I have this really cool stagger option. So in many states around the country, taxes will be paid during different parts of the year. So in Minnesota, where I'm based, for example, property taxes are due in May and October. So you pay 50% of the tax liability in May and 50% in October. Now, how this can get challenging when you're doing an underwriting assignment is the tax calendar won't always align with the pro forma calendar. So if I closed on a property today, I'm making this video in August, 50% of my taxes would be for 2020, which would be the October payment, And then 50% of my tax liability would also be for May of 2021. So it's kind of staggered. I'm paying 50% 2020, I'm paying 50% 2021, but that's all happening in year one of the pro forma. So in those instances where you're kind of buying it in the middle of the tax calendar, you can use the stagger option, and the model would know to take only 50% of this, 50% of the 2021 liability, and then plus 50% of the 2002 liability. Now, if I actually was closing on a property today, I would start the tax calendar payable as 50% of my first payment would be in October of 2020, and then everything would be accurate. Sometimes when you're buying a property significantly above where it's assessed at, that exposure will be more, and you're kind of buying yourself time if you can do that stagger option and phase that real estate tax increase in slower. Again, as I mentioned, this is a tab I've put a lot of time into over the year. I have 2 blog posts specifically covering exactly how this works, really getting into the nitty gritty, even showing you how I pulled the property tax information offline by looking at the tax statements. So make sure you check those out in that tutorial I referenced earlier. Then we get into the financials tab. It's pretty simple. I'm assuming if you're watching this video, you've already downloaded the free Tactica template for existing properties. This works exactly the same as it does in the free version. You'd enter all your historical information in columns E through H here. If for whatever reason, if you didn't have historical information, you can hide columns and just get it out of the way. I would never delete columns. I always hide everything, just so if I ever do need to backtrack, I'm not having to insert columns and rows. I mean, you're more than welcome to. The model's set up to be able to handle those kinds of alterations. But I've had a lot of clients ask me, hey, I'd just like to do a quick back of the napkin. How can I do that? Well, you don't need to enter in historical information. I'll show you how to make the assumptions here shortly, but you can make all your assumptions on a per unit basis or as a percentage of, EGI or a percentage of gross potential rent. So there's a lot of ways to go about this and do it faster. And if historicals aren't your thing, you can just hide them and make assumptions in a particular way that's not going to depend on them. Once we go over to the right here, this is where you're going to be making all your assumptions. In years 1 and 2 of the pro forma, I give you 3 different options for how you can make your assumption. You can either do a percentage increase over the historical, so that would be like your typical 3% increase over T3, T12. Or you can make your assumptions as a percentage of GPR or as a percentage of EGI. So like with your vacancy loss, you're going to make it usually as a percentage of GPR. So you can see here, vacancy loss, 5% of GPR, pretty standard. Whereas, model unit loss and garage parking, I'm just going 3% over the historical numbers. Or you can do it on a per unit basis. I don't have any except reserves. I typically, if expenses are out of whack on a project I'm looking at, I'll plug in the pro forma year 1 assumption on a per unit basis. I'll usually utilize that for expenses, but I have done it on revenue items as well. You have that same flexibility in year 2. You can do it as a percentage increase over FY1, percentage GPR, EGI, or on a per unit basis. And then starting in year 3, you have less options. I figure by year 3, you got the pro forma fairly dialed into where you want it. You're going to just do a generic 2%, 3% increase year over year. There's an asterisk here. So for vacancy and bad debt, those assumptions will always be as a percentage of GPR. Obviously, that's customary when underwriting multifamily. And then management fee as well, 5% here, or 3% here, sorry. But that will always be as a percentage of EGI. It's not like a 3% increase over the previous year, like the other assumptions. So then when you scroll over to the right, you'll have all of your operating cash flows nicely laid out for you. For rows that I'm not entering anything, I'll hide them before I print it, just so it's cleaner. Then we'll get into the return summary. So this is just a nice summary of all your cash flows. Starts with the NOI. If you have asset management, you'd enter in your fee right here. Typically, it's a percentage of revenue as well, similar to management. So all the financing is summarized here. All of the acquisition and disposition intel is in this bottom section. And then all the returns are summarized below. I have an all cash IRR, levered IRR, equity multiple, all cash return, and cash on cash return. So like the all cash IRR and all cash return, those metrics assume that they're calculating the return metrics, assuming you purchased the property 100% in cash. Now that's unlikely. Most people that are using these models are obviously using leverage and utilizing financing. But I think it's always important to compare a leveraged IRR to an all cash IRR or a cash on cash return to an all cash IRR to make sure that your leverage is accretive. I've seen so many deals when I was working in the brokerage world where people are putting on significant amounts of debt, usually going 80% LTV, and their all cash return is actually higher than the cash on cash. So that's actually hurting their annual yields. So I just, for me, it's just a way, to be able to ensure that myself and my clients are being responsible with leverage. The debt tab, honestly, it's probably one of the hardest working tabs in the model, but luckily for you, you don't need to do anything in this tab. This is just where all the amortization tables are stored. The model's really smart with assumptions. So like if you're assuming a loan and it's in the 38th month of amortization, you would type that all in on the investment summary tab, and the model will know where to start the amortization on that loan. And that's where this tab stores all that kind of information. Even if you're assuming a loan that maybe had like 36 months of IO and you're assuming it when there's 8 months left, the model will be smart enough to know to give you the remaining 8 months of IO and then begin amortizing starting in your month 9. So it's actually pretty complex, and there's a lot of stuff going on in this tab. You can see if you open up these little check marks up here, this is where the financing cash flows are flowing into the model. So depending on what you're entering in on the investment summary tab, the model knows whether it's free and clear, whether you're assuming it, or whether you're assuming a loan that still has IO, and it will put the correct debt cash flows into the pro forma based off of your assumptions there. So again, it's identical for loan 1 versus loan 2. This is where everything's stored. You don't need to do anything. Charts is another tab that there's really not much you need to do here. This is populating a lot of the charts on the investment summary tab. The only thing you need to do is type in a unit mix. Most people, and even myself, I'll just grab it right from the Renovations. So I would just copy and paste all the pertinent unit type and units from here. But you can see that I'm actually more detailed in my renovation summary. So you can see the second kind of chunk of units here, they have an R. So in this sample scenario, there's already been some units that have been renovated. That's a little more detailed than I want to get just on this pie chart here. So instead of copying and pasting on the charts tab, I just literally broke out what the 1 bedroom, 2 bedrooms, 3 bedroom. I'm not distinguishing between renovated and unrenovated. I just want like a basic pie chart showing the unit mix. So you can get you have flexibility there. Most people just copy and paste from the Renovations, but if you want to be more detailed or less detailed, you have the flexibility to do so. And then everything else in here is just populating from other tabs, and you don't need to do much with. The IRR sources, this is something that is really complex. I always liked, when I was working in the brokerage world, to understand the composition of IRR and understand where yield was coming from. This isn't going to be a helpful tool from you unless you're tracking it on every single deal you're looking at and understanding, how much IRR is coming from appreciation versus principal pay down versus cash flow growth. I have an incredibly detailed blog article explaining this. It really, for me, it helped me understand the risk in deals. Deals that are heavy in cash flow and cash flow growth tend to be less risky than ones that you're banking on appreciation and, really hoping that some buyer 5 or 7 or 10 years down the line pays a lot more than you paid for it. That's when the deals are riskier, but it's something you need to gain a feel for. Is you're tracking your deals and you're paying attention to the allocation of IRR in row 15. You'll begin to see patterns and really understand what your preferred allocations are for a particular deal. So again, it takes some time, it takes some volume to really get a good feel for this metric, but I do have a blog post explaining it if you would be interested in that. The renovation stress test is a really helpful tool as well. What this does, it holds every assumption in the model constant and just toggles what the return, the total return metrics would be if you either achieve a better or worse premium than projected, or spend more or less capital than you originally projected. So you can see on the vertical axis here, you have capital per unit. On the horizontal, you have premiums. So right in the middle, smack dab in the middle, this is what you currently have in the model. So in the model, we have $118 rental premium blended among all the units, and then a blended $8,000 per unit capital spend. So what happens here, you can see how the IRR, which is, we're distinguishing the metric up here, we'll see how the IRR changes if you get a little bit more premium, a little bit less, or have to spend more or less. You can also do this with equity multiples or average annual returns. Personally, I'm an IRR guy. The average annual return will always be higher because it takes into effect the time value of money like the IRR calculation does. You're able to adjust the hold period too to see what the IRRs will look like on a 7-year hold versus a 10-year hold. You can change the premium interval, so you can see right now it's starting at 118 and it's going up or down by 10. If you want it to be more, want it to be less, you could do 15 or 20 or whatever your preference is. And then capital, it's the same thing. It's going up by $1,000 or down by $1,000. You can adjust that as well. And then you can even toggle how long it takes to complete the premium. So, if you can do it in 2 years versus 3, that's going to help the overall IRR. As you can see, it jumped from 15.55 to 15.81. So this is a pretty powerful analysis. It holds everything else constant, all your operating assumptions, your financing assumptions, your residual assumptions, and it's just showing you how the total return metrics would change depending on how your renovation plan turns out. And finally, there's some partnership-specific models. If you're raising money from investors, I bake in some partnership structures. The first one, if you're doing just a straight profit interest or pari passu meaning equal portion, you're going in with some partners, you're each throwing in money, and you'll receive back a pro rata share of the cash flow. You would do that here. In this specific example, it's a profit interest. So the GP is not putting any money into the deal. The LP is putting in 100% of the proceeds, but the GP is going to have a 20% profit interest. Going forward, 20% of all cash flow that's distributed, the GP will get 20%, the LP will get 80%. There's a preferred return model, so you can choose your preferred return you want to pay to the LP. You would set what your contribution amounts are here, and then what that promote would be if you're achieving that preferred return each year. Also, it's worth noting that if you're doing acquisition fees, disposition fees, asset management fees, those are being tracked here as well. And it'll add your total distributions plus the total fees you're getting to show you what the total profit would be as the GP. And then obviously these partnership models are somewhat complicated. So they say the devil's in the details. So if you want to ever see what's actually going on and how these numbers how these cash flows and distributions are being calculated, feel free to click that little check mark off to the left and take a look. Again, a lot of blog posts on the partnership distributions as well. And I get very granular explaining exactly how they're working, exactly how the money's flowing. So you can feel comfortable talking to your partners and explaining to them exactly how it's going to work logistically between the GP and the LP distributions. Of course, IRR waterfall, you're setting your contributions up top here, and you can set your hurdle rates as well. The details of the partnership distributions are below. So you can see in this example, you won't get into any sort of promote hurdle 2 and hurdle 3. You can see they're zeroed out until the residual. That's when the GP would see an outsized return on the sale. You can come play with the different hurdle rates, play with the contributions, and see how that would affect the IRR and equity multiples for both GP and LP investors. And then the final one I have is just an equity multiple sales kicker. So this is just one that I've seen that I kind of liked. Basically, depending on the equity multiple that the project achieves would determine what percentage of the residual sales value the GP would get. So if the project achieves a three equity multiple, meaning the LP investor triples their money, well, then the GP is going to get 10% of that residual sales value, which in this instance is $16.2 million. So you can see it's very heavily skewed towards the residual sales value. I know some GPs or some syndicators that have a lot of confidence in what they're doing and executing a business plan. So they really want to make sure that the LPs are in a good place before they take the majority of their compensation. So that's an option as well. And then finally, there's just a tab that kind of compares all of these returns between the GP and the LP. They're conditionally formatted, so the darker cells are more beneficial. So for the GP, they might want to go with the profit interest. You can see the darker cells there, where on the flip side, there's not a lot of shaded cells here, meaning it's less enticing for the LP partner, where they were going to want the preferred return and profit interest, where that's not as beneficial for the GP. So you can just kind of compare, go back, visit the individual tabs, play with the assumptions, and see, kind of find that balancing point between what makes sense for you as the GP or for your limited partners as well. Another cool feature here, which I touched on, is In the investment summary, once you decide on your partnership structure, you can choose that here, and then it's just going to grab all the information from the individual partnership tab and pull it into this part of the investment dashboard. And I don't know that I showed this when we were going through the tab for the first time, but obviously this is the main page that you're going to show investors or partners. It's ready to be printed. It looks really nice, really professional, and you have all the information you need that highlights all the key components of all the investments. So that sums up a quick explanation of the value add model. There's tons of learning materials. I currently have 17 unique articles talking about the various tabs in this tool and really just teaching you how to not just use the tool, but really enhance the features and maximize the analysis it can do for you. I'm constantly publishing new articles, so if you purchase this tool or you already own it, you have suggestions or questions, shoot them my way. I love getting feedback and I love getting questions, and it really just helps me to improve my offering and put more informational materials out on the web that will make users feel comfortable using a tactical tool. Don't forget to check out the tutorial. Appreciate you checking out the video, and hopefully we can work together someday. Thank you.